Whether you're just buying crypto and holding or starting to explore leverage trading and shorting and longing with futures, understanding the difference between spot and futures is absolutely crucial. Today we're going to break it all down, the risks, the rewards, and which style may just fit your strategy. Be sure to like and subscribe to the channel if you have not already. My name is Paul Sampson and this is Data Dash. So first thing up, folks, is spot trading, which in crypto specifically, here's the overview of it. Essentially, you actually own the actual asset. Example is Bitcoin, Ethereum, Solana, whatever the coin of your choice is. You physically can not necessarily hold it, but you can transfer it to your own personal custody. You can hold on to it via Coinbase, Crypto.com, other exchanges that hold the asset for you, custody it on your behalf as well with pretty much 24/7 access, and you're able to actually transfer those assets to pretty much anywhere you'd like. Another wallet, whether it be a cold storage wallet that you hold off of exchanges, which is preferred for long-term investing. It's pretty much like having either cash in your personal safe or gold bars where you can actually transfer these things, protect them yourself. So obviously you want to do your homework when looking to custody your own assets in that case. But with that being said, you also have no liquidation risks. And what liquidation is when you attempt to trade or purchase an asset such as crypto. Essentially, you put leverage behind it. So when you take $1,000, for example, and you put 5 times the leverage behind it, you're essentially borrowing up to $5,000 from that exchange you're looking at, and you have only $1,000 of equity in that trade. And basically, once you lose, whether it's on the long side, meaning that you're purchasing, expecting the price to accelerate to the upside for you to benefit from that trade or that move, or if you're shorting the market where you come in anticipating the market to actually pull back, a lot of people will utilize this as a hedge position to actually make money on the downside. But in the case of liquidation, that means that you will actually either lose all of the capital you put into that trade or that investment, essentially, if you were to put leverage behind it. And in the spot world, that is not a thing, right? You have basically 100% drawdown at the end of the day, meaning that if you buy something for $1,000 today and it drops 20, 30, 40, 50, 60, 70, even 90%, you still have the allocated amount that you purchased, and then you can either decide to hold it till it comes back up, in that sense, or you're not at risk of it pulling back 20% overnight, which cryptos are notorious for, and essentially liquidating you if that was the case, even on a 5x leverage, because basically you would only have 20% to put you at 100% liquidation point if you were on a 5x trade. And we'll get into the futures trading in a second. But yeah, the liquidation is essentially when you can lose the money that you invest completely. Now, in the case of spot buying and trading, that is just where you come in and you put in whatever amount you want into that asset, and depending on what it is, if it's Bitcoin at $100,000 and you put in $1,000, you're going to get 0.01 Bitcoin, and you get to hold on to that, and whatever the valuation of that is against dollars will increase or decrease, or your currency, wherever you are in the world, as the time progresses. There are also no time constraints with spot buying, meaning that in the world of trading, once you get involved with some of these futures and things of that nature, there are times where the overall stock market, or the futures market that is open. A lot of times that tracks with the overall traditional finance market, where they'll close over the weekend. Sometimes they'll close overnight, depending on which exchange you are looking for. A lot of times it's a Forex exchange that will have those time constraints. Some of the more recent crypto exchanges don't necessarily put those on. But for example, even if you were trading on Coinbase futures, you will be subject to the times that they are closed, which is a lot of times after 5 till 7 p.m. Eastern. Then once again, over the weekends, on holidays. When you are purchasing in spot, you don't deal with any time constraints. You have full access to your assets, to your investments, and you're able to really do what you want anytime you want. And spot trading in general is best for the long-term investors, for DCAing, which means dollar cost averaging. So when you get these larger pullbacks in the market and these times where the market corrects over periods of time, you can start to purchase those assets at a lower rate than you originally did, and it brings down your overall cost basis, so that once the market does recover, you have essentially scaled into a lower price point, and then once it recovers, you have a higher upside potential, as well as lower risk tolerance. So some simple pros and cons as well for spot holding, buying, trading, investing, is that it's simple to understand. I hope that it's pretty simple in that case, right, where you just physically just buy something and you hold on to it, and whether the price appreciates or depreciates is just the simple way that you'll be able to manage your allocation, right? So if you see the market drops 10% from the time you purchased, you know that you're down 10%. If it increases 100% or 50%, you know that you're up 50%. There's no guessing in there. There's no risk of losing everything unless something truly does go to zero. You won't have to sweat these smaller 10, 20, 30% pullbacks. Another pro is that it's obviously good for holding or yield strategies, which you can actually take your spot holdings, and depending on which exchange has these abilities, but there are staking abilities where you can actually generate yield from your assets as they're just sitting there, right? So Coinbase, for example, has this ability. Some of the new ETF products are looking into it, where you basically will hold your Ethereum, your Bitcoin, potentially Solana, and things like that, USDC, and it's very similar to how a bank would give you, an APY percentage. Very interesting. Allows your money to kind of work for itself while it's basically sitting there, and also gaining value over the time when the market does increase. And then once again, as a pro, there's no margin calls or liquidation. So margin call is similar to a liquidation, where you basically you just lose everything you put into those trades because you're on leverage. And with that being said, the exchange will cut your position before they start to lose money. So whatever you put into those trades, and if you amplify it with leverage, whatever that initial dollar amount that you put in. So once again, if you put $1,000 in and you put on 5x leverage or 10x leverage, you have to think about that in the sense of percentage loss. And if that 5x leverage goes against you 20%, that now puts you at 100% because it's 5x times the 20%. That's 100% loss at that point. Same thing goes if you were to draw down 10% on a 10x leverage position. That now puts you at 100% loss. It's going to liquidate you. The exchanges will close out your accounts so that you are not at risk of basically going negative. Margin calls are the same aspect on a lot of the stock market is essentially what you'll have those. Now the cons here are you cannot profit from downside moves in spot, right? This is a simple buy and hold strategy. And if the market does pull back, unfortunately, you will bear the brunt of those pullbacks. So there's no way to benefit aside from selling exact highs, waiting for the pullbacks, and then buying back lower, right? So that is just the case of buying and holding. And then the strategy of that is that in theory, you would appreciate over time. Now there's also no leverage, which is going to mean that there's less capital efficiency. Truly, I don't think that that's really the best way to put it even, because leverage to me is a tool that should only really be used by skilled traders. And we're going to cover that pretty heavily here. But yeah, for the spot trading, there is no leverage added into it. And it does technically, depending on if you have small capital, obviously you can't put it to work as easily as you can when you come in with larger capital and just simply buy and hold for several years. And then of course, depending on the amount that you're investing, it can be slower to accumulate wealth over time or loss. Now futures trading, which means that you're going to enter positions going long, meaning you're going to buy, thinking and anticipating the market or the asset that you're choosing to increase in value, and you're betting on it going higher for you to win that trade, versus a short where you can actually come into the market now with leverage to the downside, and you can capitalize on some of those pullbacks. Once again, same rules apply here for risk management and being able to identify certain aspects, and the same things apply as well as far as the liquidation risk, right? So even if you come in and you long or you go to short this market, you put on 5x leverage and the market continues to pump 20%, then that money you put in, if you didn't put a stop loss in, is going to be absolutely lost, right? That's what the liquidation would be. But what futures trading is that you're essentially trading contracts, not physical coins. When you're buying and trading in spot, once again, you have access to those coins necessarily, or those assets you can pull off of the exchange and hold them, not necessarily physically because they're digitally, but you can have them and hold them in a cold storage wallet, access them anytime and transfer them and do whatever you'd like to with it. In the sense of the futures contracts, this is something where you cannot physically remove these from the exchange. This is just good for basically buying and selling on that exchange. It does allow you to add leverage, right? So you can go with a 2x, 5x, 10x, some even go higher than that. Truthfully, I don't really ever condone adding leverage, especially to altcoins. You'll very rarely see me adding it to anything besides Ethereum and Bitcoin. And just because those two I find that are a little bit more, by no means it's simple to trade, but they just appear to be more tradable. They're larger caps. They have a lot more data. They trade really well with the stock market at this point. But even that being said, we can see 5 to 10% just whipsaw price action. Whereas if you had 5 times leverage or more put on some of these trades, you will be at high risk of getting either stopped out really quickly or liquidated at times, and it's just not necessarily needed. But you can profit on both sides, whether it's long or short. Personally, I like to utilize the futures trading in the way of this thinking. Ideally, I'm going to use both of these strategies where I come in and I get my long-term positions, and obviously I'm going to be waiting several months, years at times for them to come into some really grand positions. And even if not, you're looking at even swing trades, swing positions that can take several weeks to unfold. We see lots and lots of ranging activity over the market, more than most times. Very rarely do we actually get the breaks, whether it's the upside or the downside. Realistically, crypto and Bitcoin specifically tend to trade in a range almost 70 to 80% of the time. So while we're waiting on those longer term positions, and while my larger capital is wrapped up in those positions, I take a smaller piece and I will take that and I will risk that into some shorter time frame trades. And when I utilize leverage for, not to take $1,000, put 10x on it and think that I'm trading $1,000, that I can potentially 2 and 3x that with a 10, 20, 30% move. Which if on 10x, that would be a 100, 200, 300% move of my $1,000. I treat this as if it's capital that I don't have to put into that exchange. I don't have to have it as risk of being lost on that exchange, or vice versa. The fact that I have my majority of capital locked up in a longer term play, this allows me to have less capital exposure, but still have the ability to utilize higher margins. So how I would treat a $1,000 trade if I was to come in and trade Bitcoin and I put 10x on it, I'm not viewing that as $1,000. I'm viewing that as $10,000. And even though on some of these P&L cards, you'll see the really big flashy 100%, 200%, 300% gains on a 10x move. So of that $10,000, and we see a 10, 20, 30% move, even though yes, my $1,000 that I put on the risk at that point can see a 3x return, I still view that as a $10,000 trade that I'm making 30% on. So yes, it'll be $3,000 in this case, or $2,000 if it was a 20% push, or $1,000 if it was 10%. But I don't view that in that sense, because what happens when you do that is that you will come into this market thinking, and really $1,000 for a lot of people is pretty much their whole account that they're trying to basically just come in and 10x and 20x and 30x, and it's not that simple. And more times than not, people are going to lose than win, right? And then what happens if you come in with $1,000 and you're treating it as your $1,000 and that's your max? You may lose a trade right away for $100 or $200, and that's now 20% of that initial balance that you put in. And now you have to come in and win bigger on the next trade. So you're going to go bigger and you're going to go heavier. You're going to put more leverage in. And that's just how people come in and just basically wipe out their accounts pretty quickly, or vice versa. You actually win that first one for $2,000 or $3,000 on that 30% move. And you either never close it because you think that you're in so well, from the areas you're at, or you do close it and you re-enter a new position and you end up just giving it all back. Or once again, going in bigger, going in with more leverage. There's just no real strategy around it. So if you are going to utilize leverage in this market, just having a really good, tight, strict strategy is the key. You can absolutely extract capital from this market each and every week. I wouldn't say every single day everybody's out here pulling out, wins and everything like that. But overall, if you have a strategy in place, you can almost come to this where as you start the week and end the week, you can potentially be in the green on these shorter term trades, but you really have to view them as that. The longer you're in these leverage positions, the more likely you are you're going to give it all back. And for me, what I utilize the leverage trades for, once again, is to, while we're waiting on these longer term plays to occur, I can capitalize on some of the shorter term moves, especially the times where the market does correct. I can actually take short positions, hedge my longs, and then when there's profits to be had, I can rotate that into cash. I wait for a red day, and I always have cash for a crash, essentially. That's how you keep that dry powder kind of constantly moving, so that you can just consistently add to those longer positions without having to consistently cash out of the long positions, hope for the drawdown, and so on. The pros and cons from the futures trading: profit from downtrends. So once again, like we just said, the shorting aspect of it is a really big plus. It does take a little bit of mental mastering to come in and actually short the market. A lot of people have a really hard time doing it, especially because the most times when you want to do it effectively, the market is very bullish and it's very exciting, and it is a little tough to come in with the opposite mindset and come in and try to short the market and think that the market's coming down. Plays a really big emotional play on you. But when you master it and you have technical analysis that goes with it, and you have some confluence and things that all line up, it will be something that is very, very important in your trading plan. At least it is for me. Once again, as a pro, the leverage allows for capital efficiency. And now in this case, I will say that, and once again, if you view it in the sense that I just explained, where if you're taking $1,000, with 10x leverage, you're not viewing it as $1,000, you're viewing that as $10,000, and you have to treat it that way. At most, you are risking $1,000 loss, right? If you're going to go with no no stop loss, which I don't suggest. But most people, that's just how they do it, unfortunately, at least to begin, and hopefully everybody learns from it pretty quickly. But if you are not going to utilize a stop loss, then you have to know that you are at risk of losing that $1,000. Probably one of the most important things that I've ever learned in this market is that no matter what strategy you utilize, no matter what your win rate is, no matter who you are, there is only one thing that you can control in the stock market and in the crypto market, and that is how much you stand to lose. So once again, if you're putting $1,000 in, then you stand to lose that. You are not guaranteed to make 10x or a 100% or a 50% move or even a 3% move, but you are guaranteed to be at risk of losing that $1,000, and a lot of times it's quick. Futures trading is also excellent for active traders. Once again, for myself, I do trade with the leverage as opportunities arise throughout either the days or the weeks. More so for me, I look for a bigger opportunity at these points where swing trades come into play. But there are so many traders out there that will utilize the leverage positions for scalping and looking at the very small moves, especially during the New York session and those few hours a day when the volatility is very high and you don't need a huge 10% move to make money, but then you're also at risk of, once again, it just all comes down to the risk management. You have to be willing and able to understand what you're doing. And of course, our cons, we have the liquidation risk, which we've kind of hit on a lot in this video, where once again, if you're putting $1,000 in, you're at risk of completely losing that, right? Unlike in spot, where if you'd have to go down literally 100% for anything to lose your money. Now, not that that doesn't happen in crypto, but it's just not as likely as putting $1,000 in on 10x leverage and getting a 10% pullback, which would take you completely out. Then there's the overtrading temptation, which I kind of hit on earlier as well, where you come in and you immediately lose $200 of that 1,000, and you want to make it back really quickly because you spent all day waiting for this, or you're afraid that the market is about to actually pump or dump whichever way you were originally going, and it just stopped you out and it's starting to reverse, and you jump back in, or vice versa. You actually have a killer trade, and now you're all hyped up and you're thinking you can do it again right away without having that cool down, that strategy. And the overtrading temptation, probably one of the top things that also take out new traders, and really traders of even longevity as well. And that really just comes down to the emotional factor of this. You'll hear this all the time when people state that you have to be emotionless and have no emotions and get your emotions in line. The emotions are not like happy, sad, and technically I guess they would be a little bit, but it's fear and greed at the end of the day. And what happens when you lose $200 of your 1,000, you get really fearful, right? You might close your position early, and then you are afraid also of missing out on it, so you jump back in. And then vice versa, when you get to a point where you're super greedy, you've gotten a great entry, you've gotten there's no reason the market should dump on you. You've gotten a nice rally out of this, and you're running into areas that you originally set out to take profit at. But now that you're there, you're rethinking it, and you're like, I'll let it go a little bit longer. The market's hot right now. You keep it going, and then you get these really quick drops, right? Or a quick reversal that basically takes you out, and you wish that you would have closed it an hour ago, 2 days ago, and then you stress about it till you basically come all the way back to break even and potentially even endure a loss. And the final con of future trading is that does require strict risk management. So it's not as simple as just walking into the market with $1,000 and just essentially rolling the dice and getting lucky. You very much will and can, but there's no strategy behind that. And then once again, with all the things we've already discussed, more than likely you'll end up losing in the long run, probably even the really short term as well. In my opinion, experience-driven risk management, professional thing to get into is the futures trading. It's very flashy and it's very inviting for a lot of newer traders and someone that has probably lower capital, because they can potentially come in and really build up an account. But for the most part, people are going to come in, fall into these 6 things that I have outlined right here, and then unfortunately they end up enduring loss and then potentially quitting trading and investing. So which one is right for you? Once again, spot, best for the building long-term positions and the beginner. I can't recommend that enough. You can't go wrong with buying and holding. I mean, that's just a tried and true strategy over time. Futures is going to be best for a disciplined trader with a system. So once again, not just someone just walking in and hoping for the best and thinking that, the market's hot and I'm going to throw $1,000 in and I'm going to 10x it. You might actually get lucky once or twice, but the majority of time, if you have no system, if you have no plan, if you have no experience in that with risk management and understanding it, if you don't have those emotions under control, you're going to lose 9 times out of 10, maybe even 10 times out of 10. Many pros will use both. Spot for macro. So even for myself, once again, I have the majority of my holdings and my investment strategy is in long-term investing. So 90 8% of my investment in portfolio is in long-term holds, and then I take 2 to 5% at times, and I'll utilize the futures for more precision, for short-term moves while we're waiting on those longer-term plays to hit, and also to take advantage of the short positions when the market is looking more likely like we're going to pull back. And if I'm not willing to cash out certain things that I've bought lower or bought years ago, and I'm just willing to risk the pullback there, I'll take short positions on Bitcoin and Ethereum, and that'll offset some of those short-term unrealized losses there. I'll actually be able to increase my buying power on a couple of things, and then once again, if we're into a red day after a drop, I can take those profits, rotate them into some of my longer-term holds, and increase my position sizes there, so that over the long term, I'm increasing that overall investment opportunity. So folks, whether you're building long-term positions with spot buys or navigating the volatility with futures trades, knowing the difference can make or break your strategy. And if you would like real-time insights, trade setups, and access to the exact tools that I use each and every day, please be sure to check out the Data Traders Club. That's where I share daily market updates, altcoin setups, and even full walkthroughs of how I'm positioning in both spot and the futures market. And of course, if you're more macro focused or prefer written insights, don't miss out on Nick's Dash Report newsletter. It's packed with in-depth research on crypto, stocks, and global economy every single week. If you're interested, please be sure to head on over to data-pro.com to get started. I hope to see you all inside. I'll see you all in the next video, and until then, everybody, cheers.